But over the past 2 weeks alone, holy shit. I mean, everyone is talking about inflation. It's a top story across all financial sites. You can look for yourself. They always list the top stories. Everywhere. It's everywhere. Why? Because consumer prices, the CPI, are now at 25-year highs. That's the CPI, guys. The gauge is created by our government to basically never show inflation. Well, now it is. The PPI, the Producer Price Index, rose by its highest amount. This is year over year. Not just 1 year, 2 year, 4 years, ever. Since they've been keeping track of this, ever. Are you surprised at this? You shouldn't be. I mean, it's a direct reflection. Commodities, look what commodities are. Look at the cost of housing. The cost of everything is going higher because materials are much higher. Why are we surprised at this? Even in China, did you see the data? Inflation, 12-year highs. We're going to see this in Europe as the rest of Asia. Europe, they're going to open up from COVID. Wait, explosion in inflation. They're going to see the same thing. And now, over the past week, some pretty powerful people have come up talking about it. And you look at Jeffery Gundlach, who's came out and said, don't count on inflation being transitory or brief. And Jeffrey's a pretty important guy. Known as the Bond King, he's a billionaire, manages a cool $135 billion through his firm, Double Line Capital. Then Jamie Dimon, CEO of JP Morgan, another pretty important person. He came out, said JP Morgan is hoarding cash right now because inflation, and I'm quoting, is here to stay. It's a pretty big statement considering he is the head of JP Morgan, and what do they manage these days? $2.5, $3 trillion? Then we had Paul Tudor-Jones coming out of the woodwork, doing a pretty cool interview on CNBC, saying go all in on the inflation trade as the Fed keeps ignoring higher prices. And they are. They're ignoring higher prices. Paul Tudor-Jones, and not one of the hedge fund managers that's mentioned often in the media, but very, very important guy, legendary, billionaire. I think he has something like $45 billion in assets under management in Tudor Investment Corp. Now, there's something these guys have in common. Other than being filthy rich, pretty smart, and we all kind of wish we were at that level. They're all old dogs. Meaning, they remember the last time we saw inflation in the 80s. They lived through it. Most of these guys were managing money during this period, and it was double-digit inflation, and it was scary. It was really scary. Double-digit inflation, which, by the way, Kyle Bass just came out, I think it was yesterday on CNBC, saying if you use a non-chained weighted index, inflation right now is at 12%. That's 80s. 12%. What does that mean, non-chain weighted? The Fed currently uses a chain weighted CPI. Again, it's a way to mask inflation. So it accounts for the fact consumers' purchasing decisions, they change along with the changes in prices, as opposed to merely measuring the regular changes in price of a fixed basket of goods. That's the textbook. What that means is, we're going to use a chain-based index because it's always going to show lower inflation. He said, don't use a chain, right? Because all of our costs across the board are higher. Why are we eliminating certain things? Why do we exclude food and energy? Why? We don't pay those prices? Really? That's what we want to do? We want to mask the inflation and make sure it doesn't look that bad? Because it is that bad. Now, why are these guys sounding the alarm? Because they understand the only way out of this mess is ugly. It's to force a recession. I mean, it's not going to be pretty. It's not fun when you're pulling a rug out from everyone, shrinking their wallets, making it incredibly difficult to borrow money. I mean, how easy is it to borrow money these days? Doesn't matter how much debt you have. They keep, hey, you're fine. Go ahead. Low interest rates. But during these times, you can see unemployment usually goes up as tons of businesses begin laying off people. See rates go higher. See lots of bankruptcies. How many companies, especially the model of the past 5-10 years, has been take out as much debt as you can. We just want to see the numbers grow. Even Disney adopted that model. We don't care about the numbers. One of the few companies you're not going to see numbers go back to pre-COVID levels probably for another 2 years because they gave away their streaming service for free and said everybody wants to see the numbers, and that pushed their stock to all-time highs, and they raised money. Good for them. The model worked. That model is really dangerous when you're sitting on massive debt piles and you're a roll-up company, which is, a great strategy with low interest rates, right? You're using your stock as currency to purchase other smaller names and build a huge company, right? So you're acquiring, using the debt markets. These guys are incredibly talented using leverage. And Oracle is a perfect example of the roll-up. That's there's just a bunch of software companies they put together, integrated. AutoNation's another one, but these guys get destroyed when it doesn't work out. DXC Technology was a former holding. We stopped at it. We learned that. It was a roll-up, and they got destroyed for a while. But it kills a lot of these companies. Think of the ESG companies that aren't expected to generate money forever. Forever. Now you got high interest rates and you're borrowing. That impacts so many companies. We're going to see asset prices deflate since higher rates cause less spending, especially discretionary spending. Because in America, we love buying stupid shit. We love buying stupid shit all the time. You want proof? Just look at Five Below. America spent $2.4 billion over the past 12 months buying crap that they probably won't use longer than a week at Five Below. $2.4 billion in sales that company did. Seriously, just look at what water balloon pumps, fidgets, an inflatable outdoor checker mat. I mean, listen, I'm guilty. I go to these stores. My daughters love it. And hey, okay, I'll inflate. Yeah, I'll play check. A week later, it's gone. We don't need fidget. They play with the fidget. It's gone. A week later, they're not playing with it anymore. I mean, I love it. I'm making fun of it. But I've never seen a store sell so much useless stuff in my life. It's pretty easy to do when you have money to spend and money to burn. And again, everybody's been handing checks like crazy. But trying to stop hyperinflation, when you're looking at it, it's usually too late. It's usually too late. And that's what's happening right now. We don't have hyperinflation yet, but we have significant inflation. And the Fed has even hinted that they're going to raise rates. Now, we have a Fed meeting coming up. I'm doing this midday Wednesday. So you're watching this later in the day if you're watching on our Curzio Research YouTube channel or you listen through iTunes or whatever. I think they may address it because we saw some really big names come out and say, hey, you really need to start addressing this. But the Fed not even concerned, and that's really what scared the shit out of me 2 months ago. Saying on the podcast, it wasn't just how the data turned so quickly, where the CPI turned and you're looking at annualized gains, and you're looking at, I'm like, right now we're at 4%, 5%. Nobody's talking about that. Are you kidding me? And the Fed's blind. They're not doing anything, and it's going to get higher and higher. We all see that. I guess everyone's calm about it because it's inflation, and we haven't seen it in more than 2 decades. But here's the big problem. Here's the thing that's not being mentioned on TV and the media. This is the biggest point. The Fed can't afford to be wrong on this. They can't hope it's going to be transitory. It's not like the credit crisis where, they know nothing and Kramer went crazy. Oh, nothing. So funny. I was working for him during that rant. And coming from New York, if I ever had a rant like that and I'm yelling and my friends are around me, they'd smack me right across the face and say, get a grip. Wish someone did that on TV. It would have been funny. Anyway, they know nothing. He was right, though, right? Kramer was right. They knew nothing. They were raising rates at the time. And he was talking to hedge fund managers, seeing how everything was blocked up. It was terrible. More pain was coming. I don't think anyone knew just how much pain. But the Fed was really late to the party. Had no clue what was going on under the hood, especially they just financially, AIG. I mean, they didn't know about AIG till like mid-2008. But the Fed came out and they fixed it almost immediately. Here's $500 billion, backstop the banks, bail out Fannie and Freddie, bail out AIG, everything's fine. I mean, how quick was that? After TARP, did we see the markets coming back? Less than a year. Just throw money at it. That's cool. Hyperinflation? Or trying to control inflation? Totally different. And if you want a good analogy, it's like having, bad kidney stones. One of the most painful things in the world. How do you get rid of it? Drink a lot of water, which means you're going to be in a lot more pain and you're going to try to pass it out. I mean, it's tough. It's extremely painful. Sometimes it can last for 30 days. I don't know if you've seen kidney stones, but it's not like, hey, I got kidney stones. Okay, here's a shot. You're good. No. Here's the process. It's a lot of pain. But it's truly amazing how nobody gave a shit about inflation a few months ago. And now everyone does. It's all over the news. And why is it such a big deal? I mean, not just the numbers, but this impacts everyone. This isn't just a stock thing. It's not Wall Street, but every retail investor, every family, everyone. And I'm using that term truly amazing because all of you, and I'm not just talking about listeners, but everybody saw this coming miles away. Miles away. I mean, you're better equipped at seeing inflation than Fed governors, economists. They get paid millions of dollars to do this job. Why are you better equipped? They do zero boots on the ground research. They're not out there like you. They're looking at lagging data. And the lagging data they're looking at, if you look at GDP, no matter what you look at, if it's retail sales, if it's PPI, CPI, it gets revised 3 times. You got GDP come out and growing at 6%, and it beats the estimates of 5.8%. You guys won't realize that next month it gets revised lower, maybe to 5.8. Then it's like 5.6. Then it could be like 5.4. It gets revised 3 times. That's all lagging data they're looking at before they catch up. You're out there. You're shopping. You see everything. I mean, you listen to these guys on TV. I mean, their job is to be on TV all the time. They're not in the field either. These guys get driven to wherever, Fox, CNN, and driven back, right? They get their own drivers, live in expensive neighborhoods. I'm sure they don't do their own shopping. I'm sure most don't eat any fast food restaurants or go to local bars like you. Because people that did that saw exactly what was happening. You saw the huge labor shortage. You saw, you go into almost any restaurant. They have signs on them. I mean, I know you've all seen them. Please be patient with the employees. They're working hard. We're incredibly short-staffed, or we're closing early. We have business operating at 60% capacity, not because of COVID, because there's no workers. They're getting paid more to stay home than work anywhere. You want proof? The numbers came out, 9.3 million jobs available, and it's about 9.2 to 9.3 people on unemployment. So if you want a job, you can get it. Say the employment rate's really at 0. Yes, there's different areas are going to have more jobs and different skill sets and stuff like that, but there's jobs available. Take away the punch bowl, and people are going to have to go to work to pay their bills. But until then, you have companies operating at 60% capacity in the services industry, and they need to be operating pretty much more than 75%. I would say 75% is break even. Everything else is gravy for some companies. A lot of expenses, employees. So now if you operate at 60, 65%, what do you do? How do you stay open? You raise prices. You got to raise prices. And we're all seeing that. You're all seeing that. The Fed's not. The economists aren't. They don't get it. I mean, you're going to the supermarket. You're seeing the cost of food explode. You're filling up your car every week when gasoline prices are surging. You're seeing your neighbors remodeling their home. The value of your home going up 25% in what, 6 months? Friends that you grew up with that you know very well driving $75,000 cars when they're sitting on $100,000 in student debt. Very easy to borrow money. Yes. And also every bill you're paying. Electricity, cable, wireless, streaming, even water, much, much, much higher. And we're not talking about year over year. We're talking month over month. Every month they're higher. You see it. So guys, please keep that in mind. Because you have a significant edge over Wall Street when it comes to investing. And yeah, these guys have the inside track on certain things, certain levels that can invest in very early stages. But when it comes to these trillion-dollar institutions trying to shift money and reallocate, they can't move that type of money without the world knowing. And they can't always move it fast enough to adapt to these major market shifts like we're seeing. 3-4 months ago, no one complained about inflation. 2 months ago, I was talking about, we see tons of people come out. I mean, it's a pretty big shift over the last 3 months where no inflation, so tons of inflation. But they can't move money fast enough without massively moving the markets. I mean, it's the reason why you see crypto is now $1.3 trillion market. Could be $1 trillion or $1.5 trillion, depending on when you're listening to this podcast. But it's such a big industry now. That's why you're seeing institutions get in, because they can move money in certain areas without too many people knowing. It's liquidity. So you need to move markets to scale. You need that liquidity. So right now, guys, you should be positioned for inflation. And I talked about this on previous podcasts. You should invest in gold right now. The real interest rates are at their lowest levels since the 70s. What is real inflation? It accounts, or the real interest rate accounts for inflation. Meaning that right now interest rates are close to zero, but as inflation goes higher and higher, if you keep your money in the bank, it means you're going to earn less. And now it's negative, and it's going even more negative and more negative. It's declining even further. But yeah, the real interest rate at the lowest level since the 70s. It's great for gold as a store of value. I also like Bitcoin. I wouldn't say Bitcoin's a store of value. I mean, ask the guy who bought it at 60,000 if it's a store of value, because it's 40,000 like a month and a half later. But still, it's a play on reckless government spending. And I like Bitcoin here. And any young investor is probably going to buy Bitcoin compared to buying gold, because gold is just too boring for them. Bitcoin's a good alternative. Also, still at this stage, invest in the reopen trade. We've done incredible draw portfolios. Recommend hotels, casino stocks that got sold off, travel-related stocks. And giving one away, Avis was a great winner for us. We're over 300% buying that not long ago. Infrastructure names. Right now, you've seen a lot of these names go up, and you're like, wow, I missed the move. They're up 200%. A lot of times, these things continue to go higher. Get tons of money. They're inflating the markets. I mean, these are good trades right now. And I see a ton of opportunity if you want to, within a particular sector. I'd say airlines. If you look at the cruises and you take their enterprise value, which accounts for debt, their enterprise, they're trading at a higher enterprise value today than they were pre-COVID. There's no cruises right now. How is that possible? So they're a little ahead of themselves. Maybe they go higher. I don't know. Airlines roared back. They're still well off their highs, but the last 4 or 5 months, they kind of haven't moved. And they have exposure internationally. Well, China's opening up. Asia's opening up. Europe's starting to open up, especially Euro Cup, guys. Great games. Germany, France, biting, goals taken away, fight. It's just, yeah, love soccer. People just throwing themselves like they just got shot. They get up there okay. But they only have half the crowds there, and I'm telling you, people are going to die because soccer's amazing. I won't even go there. I went to World Cup 2016. Greatest sports experience. I've been in so many different venues, of course, all sports. Never seen anything like that before in Brazil. Unbelievable. Those guys are dying to get back. Again, everything's going to be opening up. Just buy an airline. They still haven't. They're trading around 20-25% off of their pre-COVID highs. So they bounced back a lot, but still, I mean, try booking a flight. They have incredible pricing power. Everybody has money. Everyone's looking to get away. Even trying a rent-a-car. I have a friend who's going to come in for a month. Actually, one partner is going to come in for a month with his family and hang out where I live in Amelia Island, Florida. And he wanted to rent a car. And he asked, he's like, Frank, do you have an extra car or anything? He said, I was going to rent it. It's $4,000 to rent the car for the month. $4,000. $4,000. Anyway, I mean, you're looking at the airlines, and that's rent-a-cars good favors, I guess. But you're looking at airlines. These guys have plenty more room to run. I'd say they went about 60% of the way, and they should be touching all-time highs because those margins are going to explode. They're going to be buying new planes like crazy from Boeing. They had all these orders in due to high demand. They had to cut back. I mean, that demand's coming back. It's going to be much, 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 much greater than it ever was. So they're going to continue with those orders. You'll see Boeing come back, but the airline industry is a place where you could definitely outperform. Now, is there a chance that we do not see hyperinflation? Absolutely. I mean, the bond market for now is not pricing in huge inflation. But to be fair, the bond market was not pricing in anything to show the credit crisis late 2006, 2007. At least not from the data I look at. But I do have a friend who's the largest, or one of the largest, I'll say, or if not the largest independent bond fund manager. Probably saw that coming back then because he's one of those people incredibly smart, just sees things nobody else does. He's also been a mentor to me. He's bouncing ideas off him. Great guy. Very, 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 very smart. But I mean, he saw it coming. But still, I remember looking at 2006, 2007, it didn't really show. So I don't know what, the bond market's not showing. And that's the argument. And of course, inflation could be transitory. Maybe they're right. But the Fed cannot afford to get this one wrong. They can't be late to the party. And in fact, they're not even concerned with inflation. That's what scares the hell out of me. Again, they may come out right now. It's before the Fed meeting. They're meeting. They're going to come out and I'm sure with all the big names that are worried about inflation, Again, JP Morgan has a direct line into the Fed, and a lot of these guys do. But maybe they come out and say, okay, we're not seeing it. Maybe interest rate, again, I think November 22 is expected interest rate hike. You see that push forward a little bit. At least talk about it. But for the Fed not even to be concerned when we're seeing these numbers is insane. It's insane. I mean, the Fed should be raising rates right now. And that's why you should position yourself accordingly. Because the Fed right now, pedal to the metal. Continues to buy bonds, low interest rates, not worried. Even though stocks, home prices, commodities, everything near all-time highs. Wages are rising, all the bills you're paying. Every company in the world is raising prices. You listen to conference calls, everyone is raising prices. They need to. You know, the Fed has added close to 35% more money to the system in the last 14 months. And more is coming in infrastructure, which, by the way, I don't care what party you're on, but about 10% of that bill was for infrastructure. Everything else is for bullshit. Again, more money being injected into the system. They're not done. They get addicted to this, the politicians. They love it. They love when there's a crisis. They love it. Increase spending, get money for everything. They all become incredibly wealthy. They love when there's a crisis. Push the issue, get as much money as they can, because it benefits them.